You did the responsible thing. You built the emergency fund. You stopped buying coffee out. You watched your balance creep up, 5,000, 10,000, maybe more, and you felt good, proud even. And then you checked what that same amount would have turned into if you just moved it into the market 5 years ago and your stomach dropped. Because being good with money and being disciplined got you exactly nowhere. While people who took what looked like a bigger risk are sitting on gains you can't even math your way into anymore. That's the cruel joke nobody warns you about. Saving feels safe, but sitting in cash while everything gets more expensive is its own kind of risk. It's just slow enough that you don't notice you're losing until you compare notes with someone who didn't play it safe. You're not behind because you're bad with money, you're behind because you were taught half the lesson. Saving was never the finish line. It was supposed to be the on-ramp. Today I'm giving you the other half, the exact step-by-step bridge from where your money sits right now to where it should actually be working. Stick with me, because by the end of this, you're not going to have vague inspiration. You're going to have a mechanical, boring, repeatable process. And boring is the whole point. Boring is what actually builds wealth. Here's the lie you were sold. Probably by a parent, a teacher, or some finance influencer with a rented Lamborghini. Just save your money. That's it. That's the entire financial education most of us got. Save, don't spend. Be careful. Nobody ever finished the sentence. Nobody said save it. And then once you have a foundation, move it into assets that grow faster than inflation destroys it. They just stopped at save. Like that was the whole curriculum. And because of that missing second half, millions of disciplined, hardworking people are sitting on cash that is quietly shrinking in real terms every single year. Not because they're doing anything wrong. Because they were only given one tool, and they've been using it for a job it was never designed to do. A savings account is a parking lot. It is not a vehicle. You don't get anywhere sitting in a parking lot, no matter how clean you keep the car. Here's the part that should actually make you a little angry. Inflation in a normal year runs somewhere around 3%. Your typical bank savings account pays you somewhere between 0.5% and maybe 2% if you shopped around for a decent online bank. That means every year in real purchasing power, your safe money is losing ground. Not dramatically, not enough that you'd notice on a bank statement, but compounded over 10, 15, 20 years. That quiet erosion is the difference between retiring comfortably and working until you're 75, because the math never worked. And this isn't an accident of the system. This is the system working exactly as designed. Banks want your cash sitting still because your cash sitting still is their cheapest possible source of capital. They take your deposit, they lend it out at 5, 6, 7, 8% to someone buying a car or a house, and they pay you a fraction of that spread for the privilege of using your money. You are, functionally, an unpaid or barely paid lender to a bank that then goes and invests your money far more aggressively than you're allowed to believe is safe for yourself. The people who actually build wealth figured out decades ago that saving is step 1 of 2, not the whole plan. They save enough to be stable, and then they get their money into assets, stocks, index funds, real estate, businesses, that are mathematically designed to outpace inflation over time. That's it. That's the entire secret. There's no insider trick, no secret account, no special access. There's just a second step that most people never take because nobody ever told them it existed, or because the idea of investing got tangled up in fear. Fear of losing it all, fear of the stock market being a casino, fear of not understanding it well enough to do it right. Today, we're removing that fear by removing the mystery. I'm going to give you the literal steps in order with the numbers, so there's no ambiguity left about what to actually do with the money sitting in your account right now. Before we get into that, if you've made it this far, you already care more about getting this right than 90% of people who will scroll past this video. Do me a favor and hit subscribe, because I break down exactly this kind of no-fluff financial mechanics every week, and drop a like if you're ready to actually stop parking your money and start moving it. Let's get into the steps. Point 1. Know the difference between saving and investing, and where the line actually is. Most people think saving and investing are the same activity with different levels of risk. They are not. They serve two completely different jobs, and confusing them is the single biggest reason people either invest too early and panic sell, or save forever and never invest at all. Saving has one job: preserve capital and keep it liquid for emergencies or near-term needs. That's it. Saving is not supposed to grow your wealth. It's supposed to protect you from disaster, a job loss, a medical bill, a car that dies at the worst possible time. The standard rule, and it's standard for a reason, is 3 to 6 months of essential expenses sitting in a boring liquid FDIC or equivalent insured account, not invested, not touched. Just sitting there as your shock absorber. Investing has a completely different job. Grow capital over a long time horizon by accepting short-term volatility in exchange for long-term compounding. Investing money is money you do not need for at least 5 years, ideally longer. That's the dividing line, not your comfort level, not your gut feeling, your time horizon. Here's where people get it wrong in both directions, and both mistakes are expensive. Mistake 1, they keep way more than 6 months of expenses in cash because pulling the trigger on investing feels scary. And that extra safety cash, say they're sitting on $40,000 when their actual expenses only require $15,000, that extra $25,000 is now doing nothing for 20, 30 years of their life. Let's do the actual math on what that costs them. $25,000 sitting in a savings account earning 1.5% over 25 years becomes roughly $36,000. That same $25,000 invested in a broad market index index fund, averaging a historically reasonable 7% annual return after inflation, over the same 25 years becomes approximately $135,000. That is not a rounding error. That is essentially $99,000 in opportunity cost. Gone. Because extra safety felt more comfortable than doing the math. Mistake 2, the opposite problem. People invest money they actually need in the short term because they got excited watching some stock rip up 30% in a month, and then the market has a normal, healthy correction, which happens on average every year or two. And now they need that money for rent, and they're forced to sell at a loss. That's not investing. That's gambling with your own oxygen supply. The psychological root cause here is what behavioral economists call recency bias. You saw the market go up recently, so your brain assumes that's the normal state of things, and it discounts the very real, very statistically expected possibility of a drawdown, right, when you can least afford it. The practical, non-obvious execution rule here: before you invest a single dollar, sit down and calculate your actual monthly essential expenses: rent or mortgage, utilities, groceries, insurance, minimum debt payments. Multiply that number by 4 as a bare minimum floor. 6, if your income is unstable or commission-based. That number sitting in a high-yield savings account, not a checking account, an actual high-yield savings account, because even within safe money, there's a difference between earning 0.5% and earning 4 or 4.5%. That number is your untouchable floor. Everything above that floor, once you've hit it, gets redirected. Not eventually redirected on a schedule, which we're going to build later in this video. Point 2, the emergency fund threshold. Stop moving the goalposts. This is where I need to be blunt with you, because this is where most people quietly sabotage themselves without even realizing it. Once your emergency fund hits the target number we just calculated, you are done funding it, full stop. And yet, I watch people over and over hit their 6-month number and then decide, well, maybe I should have 8 months just to be safe. And then they hit 8 months and decide maybe 10 is smarter. This isn't caution. This is fear wearing a disguise that looks like responsibility, and it's one of the most common ways discipline gets weaponized against your own future. Let's put a real dollar figure on what that costs. Say your essential expenses are $3,000 a month. Your 6-month emergency fund target is $18,000. If you stop there and start investing everything above it, and you're able to invest an additional $500 a month on top of that starting base, here's what 30 years looks like at a conservative 7% average annual return. Your invested contributions alone, $500 a month for 30 years, grow to approximately $610,000. Now, compare that to the person who kept pushing their safety number up to 12 months, 24 months, then just never got around to starting. Because the number kept moving, that person, doing the exact same job, earning the exact same income, retires with a fraction of that, purely because their definition of enough safety never stopped inflating. The psychological mechanism at play is loss aversion, and I mentioned this in the intro because it's the single most expensive bias in personal finance. Your brain weighs the pain of a hypothetical future loss almost twice as heavily as it weighs the pleasure of an equivalent gain. So when you imagine investing that $18,000, your brain isn't running the math on 30 years of compounding. It's running a worst-case simulation of what if the market crashes next month and I lose access to this money. That fear is not irrational. Markets do crash, but it's miscalibrated because it's applying a short-term risk lens to a decision that should be evaluated on a decades-long timeline. Here's your practical, non-obvious execution rule. Write your emergency fund number down, on paper or in your notes app today, before you finish this video. Not a vague feeling, an actual dollar figure calculated from your real expenses. And then treat that number the way you'd treat a locked door. Once you hit it, the next dollar doesn't go into savings. It goes into the investing pipeline we're about to build, automatically, without a debate happening in your head every single month about whether now feels like the right time. Because it never will feel like the right time. That feeling is the trap, not the signal. Point 3. Choosing your investment vehicle, tax-advantaged accounts first, always. This is the step where most people either freeze up from overwhelm or make an expensive mistake by doing it backwards. So let's do it in the correct order, because the order matters more than almost anything else in this entire process. Before you open a random brokerage account and start buying individual stocks because someone on the internet told you to, you need to understand account types, because the account type determines how much of your gains the government takes from you. This is not optional knowledge. This is the difference between keeping your money and giving away a huge chunk of it unnecessarily. If your employer offers a retirement plan with any kind of matching contribution, a 401k match, for example, that match is the single highest guaranteed return available to you anywhere in the entire financial system. If your employer matches 50 cents on the dollar up to 6% of your salary, and you're making $60,000 a year, that's an instant 50% return on the first $3,600 you contribute, before the market has done anything at all. Nowhere else in investing do you get a guaranteed 50% return on day one. Not real estate, not crypto, not stock picking. If you're not capturing that full match, you are leaving free, guaranteed money sitting on the table, and that should genuinely bother you. After you've captured the full match, the next priority is typically a tax-advantaged individual account. The specific type depends on your country and your tax situation, so I'm not going to pretend there's one universal answer. But the principle is universal. Tax advantage space is limited and it doesn't roll over indefinitely in most systems. So you use it before you use a fully taxable brokerage account. The math here is significant. In a taxable account, you're paying capital gains tax on your growth. And depending on your bracket and how long you hold, that can be a meaningful percentage cut out of your returns every single time you sell. In a tax advantage account, that same growth compounds without that annual leakage. Over 30 years, the difference between paying and not paying capital gains tax on your growth can easily be the difference between retiring with, say, $700,000 versus over $900,000 on the exact same contribution schedule. Only after those two buckets are filled, the match, then the tax advantage space, does a standard taxable brokerage account come into play. And that's fine. That's exactly where it belongs. It's just not where you start. The psychological trap here is what I'd call shiny object investing. People skip the boring account structure step entirely because it feels administrative and unglamorous, and they jump straight to downloading a trading app and buying whatever stock is trending, because that feels like real investing. It's not. Real investing is 90% boring infrastructure and 10% actual asset selection. The infrastructure is what determines whether you keep your gains. The asset selection is almost secondary by comparison. Your practical execution rule: this week, find out 3 things. 1. Does your employer offer any kind of matching contribution? And if so, are you currently capturing the full amount? 2. What tax advantage account options are available to you individually? 3. What the actual contribution limits and rules are for those accounts this year. Write those 3 answers down. That's your map. Everything after this point in the video assumes you filled that map in. Point 4. The mechanics of actually moving money. Automation over willpower. Here's a hard truth about human psychology that the entire finance industry knows and most individuals don't. Willpower is not a reliable long-term financial strategy. It's not that you're weak. It's that willpower is a finite resource that gets depleted by every other decision you make in a day. And financial decisions made in the moment. Should I move this $200 into investments this month? Or should I just leave it in checking because I'm not sure? Those decisions get made when you're tired, distracted, or emotionally reactive to something completely unrelated to money. The solution the wealthy figured out generations ago is brutally simple. Remove the decision. Automate the transfer so that the money moves before you ever have the chance to talk yourself out of it. This is sometimes called paying yourself first. And it works not because of some mystical financial principle, but because of basic behavioral economics. Money you never see in your checking account is money you never psychologically register as available to spend. Let's run the actual numbers on why this matters so much. Say you intend to invest $300 a month, but you do it manually, and because life happens, you actually only follow through about 7 months out of 12, which, by the way, is a realistic and common outcome for manual willpower-based systems. Over 30 years, that inconsistent $300 a month, averaging out to roughly $175 a month in actual contributions, at 7% average annual return, grows to somewhere around $200,000. Now compare that to the exact same $300 a month, fully automated, hitting your investment account the day after your paycheck lands, every single month, without exception, without a decision required. That grows to approximately $367,000 over the same 30 years, same income, same intention. The only difference is automation removing the willpower requirement, and that difference is roughly $167,000. The specific, non-obvious execution rule here is this. Set up your automatic transfer to happen one day after your paycheck deposits, not on some arbitrary date like the first of the month. Why does the timing matter? Because if the transfer happens before you've had a chance to see that money sitting in your checking account and mentally allocate it towards something else, you never build the habit of spending it in your head in the first place. If you set the transfer for a date disconnected from your paycheck, there's a real risk the money's already earmarked for something else by the time the transfer date arrives, and you either cancel it or reduce it. Align the automation with the income event itself. Point 5. What to actually buy, index funds over stock picking, and why the math backs it up. Now we get to the part everyone wants to skip straight to, and the part I've deliberately made you wait for, because buying the wrong thing with the right process is still a mistake, but the process actually matters more than people think. Here's the ruthless, unfiltered truth. The overwhelming majority of individual stock pickers, including professional fund managers whose entire job is picking stocks for a living, underperform a simple, low-cost, broad market index fund over any meaningful time horizon. This isn't opinion. This has been studied extensively, and the pattern holds up year after year. A large majority of actively managed funds fail to beat their benchmark index over 10 and 15-year periods after fees are accounted for. If professionals with research teams, data terminals, and it as their full-time job can't consistently beat the index, the odds that you, picking stocks based on a headline you read or a tip from a friend, will consistently beat it are not good. Let's do the math on why fees alone should scare you away from actively managed funds even before we talk about stock picking performance. Say you invest $50,000 over 30 years at an average 7% return. In a low-cost index fund with a fee of roughly 0.03 to 0.1% annually, your fees over 30 years total maybe a few $1,000s, and your ending balance lands somewhere around $380,000. In an actively managed fund charging a seemingly modest 1% annual fee, which sounds small, and that's exactly the trap, that 1% compounding against you every single year, on a growing balance over 30 years can eat away $60,000 to $80,000 or more of your final total, even before accounting for the fact that fund frequently underperforms the index. It's trying to beat anyway. You're paying more for a worse result. That's not a strategy. That's a fee structure designed to benefit the fund manager's income, not yours. The psychological root cause behind why people still pick individual stocks despite this overwhelming math is something called overconfidence bias, mixed with a very human desire for a good story. "I bought this company because I believed in it" is a much more satisfying sentence to say at a dinner party than "I bought a boring index fund that owns a tiny slice of 500 companies." Stock picking feels like skill. Index investing feels like admitting you don't have an edge. But admitting you don't have an edge, when the data says almost nobody consistently does, isn't weakness. It's the single most financially rational decision available to the average person. Your practical, non-obvious execution rule: for the vast majority of your long-term investing money, put it into a low-cost, broadly diversified index fund, something that tracks a total market or a large-cap index, with an expense ratio under roughly 0.2%. If you want to scratch the itch of picking individual companies because it's genuinely fun for you, that's fine. Human beings are allowed to have hobbies. But cap that fun money stock picking portion at somewhere around 5 to 10% of your total invested portfolio. Treat it like entertainment spending and never let it compromise the 90+% that's doing the actual heavy lifting of building your retirement. Point 6. Riding out volatility, the step where most people destroy their own returns. Here's the uncomfortable statistic that explains almost every disappointing investing outcome you'll ever hear about. The average investor's actual returns are significantly lower than the actual returns of the funds they're invested in. That gap has a name. It's called the behavior gap, and it exists for one reason. People buy high when everything feels good and headlines are optimistic, and they sell low when the market drops and panic sets in. The fund itself might return 7% a year over a decade. The average person invested in that same fund might only capture 4 or 5%, purely because of when they bought and sold, based on emotion rather than plan. Let's put a number on what panic selling actually costs. Say the market drops 20%, which statistically happens periodically and is a completely normal part of long-term investing, not a rare black swan event. If you panic and sell at the bottom of that drop, and then sit in cash for a year while you wait to feel safe again, you don't just lock in that 20% loss. You also miss the recovery. And historically, some of the market's best single days happen within weeks of its worst days. Missing even the 10 best trading days over a 20-year period can cut your total return roughly in half compared to someone who simply stayed invested through the entire period, drops included. That is an enormous, almost unbelievable cost for a decision that felt in the moment like it was protecting you. The psychological root cause is loss aversion again, compounded by what's called herd behavior, when everyone around you is panicking and selling, and every headline is screaming about a crash. Staying invested feels irresponsible, even though mathematically it's the correct move for anyone with a long-time horizon. Your brain isn't built to calmly evaluate 30-year outcomes while watching your account balance drop in real time. It's built to avoid immediate visible pain. Your practical, non-obvious execution rule: before you invest a single dollar, write yourself a short letter, an actual letter, to future you, that says something like, when the market drops 20 or 30%, which it will at some point, this is not a sign something is broken. This is the cost of admission for the higher long-term returns investing offers over saving. I'm not going to check my account daily during a downturn. I am not going to sell. I am going to keep my automated contributions running, because a downturn means I'm buying the same assets at a discount. Put that letter somewhere you'll actually find it during a crash, because the version of you calmly planning today is a completely different psychological state than the version of you staring at a red account balance in 6 months or 6 years. And the calm version needs to leave instructions for the panicked version, the harsh reality and the action plan. Let's be honest with each other for a second. None of what I just gave you is exciting. There's no secret stock symbol, no insider strategy, no shortcut that skips the boring parts. And that's precisely why it works, and precisely why most people won't do it, because the entire finance media ecosystem is built on making you believe wealth requires some clever discovery, when the actual data says wealth requires a boring process, repeated without emotional interference, for a very long time. Here's what you're doing tomorrow morning, in order. First, calculate your actual monthly essential expenses and multiply that by 4 to 6 to get your locked emergency fund target. Do this with a calculator, not a guess, and move that number into an actual high-yield account if it isn't already there. Second, if you have any employer match available and you're not capturing the full amount, log into your benefits portal tomorrow and fix your contribution percentage. That's free money, and every month you delay is a month of free money you don't get back. Third, once your emergency fund is confirmed funded, open or confirm your tax advantage investment account and set up an automatic transfer time to land 1 day after your paycheck deposits, not the first of the month, the day after payday. Fourth, direct that automated contribution into a low-cost, broadly diversified index fund, and if you want individual stock exposure for fun, cap it at 5 to 10% of the total. Fifth, write that letter to future you about staying invested through drops and put it somewhere you'll actually see it in 6 months. That's the entire path. Not complicated, not mysterious. Just 5 specific mechanical actions that most people know about in theory, and almost nobody actually executes in order, on a schedule, without letting fear or distraction interrupt the process for years at a time. The gap between where you are right now and financial independence isn't a knowledge gap anymore. Not after this video. It's an execution gap. And execution gaps only close one way, by doing the boring next step today instead of the exciting research tomorrow. If this video gave you the missing half of the lesson nobody finished teaching you, there's a companion piece on this channel that goes deeper into exactly how much money you actually need before you're allowed to call yourself financially free. And the number is probably very different from what you're currently assuming in either direction. Go watch that one next, because saving and investing were only ever step 1 and step 2. Knowing your real number is step 3, and most people never even calculate it. Click through, do the math with me, and let's keep building this thing properly.